Good morning. I'm Harley Schlanger from the LaRouche Organization with your daily update for March 30th, 2021. Today we're going to take a look at the crazy world of economics and finance in the Western world. Or I should say, actually, it's worldwide now because in the aftermath of the decision in 1971 to remove the dollar from the gold reserve standard, we've had nothing but an increasing measure of insanity. It's the only way to discuss it with the casino economy, increasing amounts of money coming from central banks into speculative pools and pulling that money away from physical production. And what we've seen in the last days has been, if you watch MSNBC or CNBC rather, CNN Business, any of the business channels, Fox Business, read the Wall Street Journal, any of the press, all they're focused on is the Federal Reserve. Inflation, is it going up or not? If it goes up, does that mean rates go up? What will that mean for investors? It's as though the entire economy is in the hands of the Federal Reserve decision whether or not to raise interest rates. Now, that is true because of the shift away from a real economy. And you listen to what Jerome Powell said when he spoke before the Congress. Everyone was focused on, is he going to raise interest rates or not? And the conclusion was no one could tell for sure. But he said that there will be a gradual and transparent policy on interest rates, gradual raising of interest rates, and the Fed will roll back the amount of treasuries and mortgage-backed securities we're buying. Now, the market swings up and down wildly on pronouncements from Powell and some of his colleagues at the Federal Reserve, and then the analysts who talk about, does he mean this, does he mean that? This, of course, goes back to the Fed speak of Greenspan, who there was a whole tribe of people hired to try and figure out what he was really saying when he made his speeches before the Congress. But you might ask yourself, when the markets are swinging up and down, people are trying to determine, is inflation really coming? And of course it is. Inflation is much higher than the official figures. And if so, will the Fed raise rates? Now, did it ever strike you that there's something strange about this? That the economic well-being of a nation depends on handfuls of traders who make bets based on, in some cases, wild intuition, but in most cases, trying to guess whether rates are going up and down, and if they're going up or down, where they should put their money into which investments. Now, and by investments, I mean into financial instruments. Now, this is a sign that we have become a full-fledged casino economy. And as long as the house will provide chips so that people can play, they're going to continue to gamble. Now, the difference is, if you go to Las Vegas and gamble and you lose, that's it, you're out. But on the Wall Street City of London system, if you lose and you lose big enough, you'll get bailed out. And so as a result, risk means nothing. And so when they talk about pricing risk, they're basically talking about, can they go somewhere else to get bailed out if they can't immediately get it from their commercial bank? Now, an economy is not about artificial or fake valuations of financial paper, stock prices, and so on. And when these are backed by an unlimited volume of liquidity, then in a sense, it's the house guaranteeing profits to the handfuls of speculators while the real economy is being torn down. Now, an example of this is what happened with Archegos Capital hedge fund. I don't know if I'm pronouncing it right. It looks to me like it should be Archegos. But this is a hedge fund that had at least a $6 billion loss in the last couple of days, and it shook up the markets. They had margin calls from banks demanding that they come up with some real money for more collateral for their equity swaps trades, which are a specific kind of derivative trade that they were engaged in. And this was triggered by a big drop in share prices of Viacom CBS, which fell 30%. So a stock falls, A hedge fund then is hit by margin calls, and as a result, major banks face big losses. Nomura, Japan's largest investment bank, lost $2 billion. Credit Suisse at least $1 billion, but some are saying as much as $4 billion. Now, what was Archegos doing? They were buying derivatives which allow you to bet on stock prices without owning the securities. So this is another step removed from actually something that's real. At least stocks are to some extent, at least in the old days, were based on an underlying value of a company. Does it have plant and equipment? Does it produce something? Does it produce an income? Increasingly now, stocks are going up of companies that don't produce an income or don't produce enough money to cover the interest on their debt. So what happens when you have people betting on these kinds of stocks? Now, to make matters worse, when the bets are placed by Archegos, they're not buying these positions with cash, but they put up collateral, which is then they then borrow money from banks to be able to pay for it. In other words, it's highly leveraged. There are large loans to take positions on ups and downs in the market. Archegos, for example, has $10 billion supposedly in assets, but positions that are worth between 30 and 50 billion. And there are many companies that have even worse relationships to leverage. Remember in 2008, when Merrill Lynch went down, or when Lehman Brothers went down, rather, it was between 30 and 40 to 1. For every dollar of real assets, they had $30 to $40 of phony instruments. Now, the lender banks for Archegos were Goldman Sachs, Morgan Stanley, Deutsche Bank, Credit Suisse, Nomura, and a handful of others. Now, what happened is that when these banks or these trading companies were going to get hit due to their large positions in falling stocks, they sold large volumes of those stocks. And that's why the market went down based on the story of what was going on with Archegos. Now, what do analysts say? Don't worry, don't worry. We've got it covered. The fundamentals look good. What are the fundamentals? Don't worry, the Fed will continue to provide the liquidity to paper this over. Now, as this is going on, we're seeing the Biden administration come forward with its next phase of so-called Recovery Act. Two stimulus bills of $1.5 trillion each, supposedly for infrastructure, or what the senator from Wall Street, Chuck Schumer, called the new green way of infrastructure. Now, as we've reported, green technology is a net drain on the economy. It's not safe, it's not reliable, it's not secure, it doesn't provide enough electricity, as we saw in Texas recently. And so what are you doing? You're moving into an energy production source which is not capable of supplying the needs of a real physical economy, which means more will come out of the physical economy to go into the speculative economy. If these bills pass, and this new $3 trillion is put forward for infrastructure, for green infrastructure, then the Fed's total money printing in the last 18 months will reach $9 trillion borrowed from the Treasury against taxes, plus an additional $5 trillion, which they made available to bank reserves. All that in 18 months. So that's $14 trillion produced by the Federal Reserve to underwrite a speculative system which is failing. Now, the growth of the money supply goes almost entirely for speculation. There's no investment in physical goods production. This is dropping month by month, according to the Fed's own statistics. There's no investment in productive technologies and research and development. Companies are cutting the costs there. And then we complain about China spending money on their infrastructure and research and development. And the third area of disinvestment is infrastructure in the United States. So in every single area that real wealth can be produced, we're seeing a cutback in investment, cutback in spending, moving into areas where speculators determine the prices, And the prices are determined not on what can be added to the real physical goods production or the real value added to the economy, but on how much suckers are willing to pay for instruments which have no underlying value. Because remember, what is a derivative? It's a contract whose worth is derived from something of value but has no value in itself. In other words, it's a bet on a piece of paper or a bet on a notation on a computer device. So this is the world we live in. This is why the LaRouche organization insists that we must pull the plug on the speculative system and move back toward a real economy based on the American system, investment in physical goods production through a credit policy, through a national bank, like a Hamiltonian credit bank, an end to this propping up of speculators, and tailoring the investment so that it's directed primarily into real infrastructure, research and science and technology, and then bringing online those new technologies to increase the productivity of the labor force. That's how you build an economy, not through speculation and wishful thinking that a piece of paper that you're holding will go up in value. So thanks for joining me today, and I'll be back again tomorrow.